Demand for investment management remains exceptionally strong. Total assets worldwide reached an all-time high of approximately 41 trillion euros at the end of last year. Total net sales in 2017 were another record at 2.4 trillion euros. Global industry assets have been growing at a constant annualised rate of around 11% a year since 2012. The global industry faces its fair share of challenges, however. Regulatory pressures and uncertainties, technology change, the unrelenting rise of passive investments and margin pressure, to name a few. One bright spot for active investment managers has been the sustainable investment theme. Sustainable fund assets have grown at a constant annualised rate of around 15% over the last 5 years. That's well ahead of the 11% globally, and has resulted in sustainable fund assets more or less doubling over the last 5 years, albeit from a low base. Were the current growth rate sustained, then sustainable mutual fund assets will exceed 1 trillion euros by 2022, which is a level comparable with countries like Canada in terms of assets under management. This growth and investor demand is well illustrated in the recent acceleration in sustainable fund launches. Within the sustainable fund category, an important recent development has been the advent of green bond funds. I discussed these funds at this conference last year. Since then, growth has firmly taken hold. We estimate that Europe-domiciled green bond fund assets totalled about 2.8 billion euros at end 2017. That is undoubtedly a low level. However, the growth in 2017 was almost 40%. That compares with global mutual fund growth of around 7%, sustainable fund growth of about 14%, and looking across Europe more broadly, in terms of bond funds, growth of around 12%. We anticipate the growth rate in this segment will remain strong. Investor demand for sustainable funds appears exceedingly strong. Within the green bond fund sub-asset class, some technical drivers will become important in 2018. Specifically, many investors and intermediaries will only consider funds once they've achieved minimum assets under management and a track record of at least 3 years. We count 9 funds with combined assets under management of about 1 billion euros, which will achieve 3-year track records during the course of 2018. Clearer regulatory classification of green bonds, likely later this year, could be another spur for investment. Green bond funds actively highlight their green credentials. A cursory examination of the fact sheets of these funds will reveal a wealth of supplemental, non-financial information from their sustainability analysis and scoring through to their carbon footprints. Green bond fund investors clearly value this disclosure. However, these funds remain bond funds and as such are exposed to conventional bond risks. In terms of credit quality, we estimate the fund credit quality rating of European green bond funds somewhere in the BBF to single AF range, based on our global bond fund rating criteria. As such, their credit quality is typically lower than representative green bond indices. Compared with the indices, these funds tend to overweight BBB exposures and may be able to assume some, albeit limited, high yield exposure. They also tend to underweight the highest quality sovereign, supranational and agency exposures that dominate green bond indices. All else being equal, these funds incur greater default risk than the indices. Duration is a meaningful risk for these funds. We estimated an average duration of 6.4 years across our sample of European green bond funds at end December 2017. These funds' duration has been skewed by exposure to certain very large, long-dated and fixed-rate government issuances, notably France's 2017 issuance of a €7 billion green bond with a 2022 year maturity. Broadly speaking, fund and index duration has been increasing across all fixed income sub-asset classes. So in this regard, green bond funds are no exception to the norm. Indeed, their duration is comparable with aggregate European broad market indices. However, there is undoubtedly risk here. Without effective risk management, these funds would be meaningfully exposed to rate movements. In summary, much as the demand for these funds is strong, investors would be minded to understand their exposures and the risks they assume. While the investment strategies of these funds may seek to deliver societal good, green is not the new black. Credit fundamentals matter as much as they always have.